everybody to Supply Chain Insights Lithium Outlook webinar. Just as a recap, Supply Chain Insights is a specialist lithium-ion supply chain research and consultancy. We do a lot of work advising people on asset level due diligence, market forecasts, long-term planning, and also term sheet advisory across the supply chain. And we do that across the lithium-ion sector, from raw materials through to the battery cell. If you'd like to know more about Supply Chain Insights, please feel free to reach out to my colleague. There'll be some contact details at the end, or you can scan the QR code there. So moving on to lithium, I guess the most telling graph is the price, what we've seen happen to lithium prices over the past year or so. We did a lithium webinar for subscribers back in March 23, and I'll refer back to one of the slides from that just to show how our predictions have played out. But just to sort of recap on what's happening in the market at the moment, I think overwhelmingly you're seeing negative sentiment towards the whole supply chain, the whole electric vehicle supply chain. A lot of that is because of effectively overcapacity in some aspects of it. So you've got overcapacity in cathodes, overcapacity in cells. You're into a surplus market, mainly on the lithium and lithium chemical side, although we'll look at that in a bit more detail in a moment. Equity valuations are very weak, particularly in the lithium producer space. And a lot of the listeners will be interested to hear our views on that. And now what you're seeing is the market's rebalancing towards this new environment of low prices. What you saw over the period of incredibly high costs was production costs ran up, CapEx and OpEx went up hugely. But now we're almost in a sort of deflationary environment as people are trying to produce the most profitable ton rather than the most tons that they can produce. That takes time to have an impact, but it will have an impact as we go through the market. The other thing that's really important to bear in mind is the demand story hasn't changed. If anything, lower prices are making the demand story even stronger, especially in energy storage systems. And what that's doing is it's putting us at risk that the market price will curtail investment too much. And if that happens, you're going to be set up for another price spike. As we'll look at over the next couple of slides, that's potentially very negative to the market if prices continue to decline. That said, I think we're relatively optimistic here that prices have now stabilized, and there's a good chance that we will see a price recovery over the coming month or 2 months, certainly after Chinese New Year. And again, we'll look at the reasons as to why we think that is. Jose, I'll bring you in there. Any first comments or thoughts looking at the lithium price chart?
Yeah, absolutely. So first of all, it is worth to mention that the demand is still robust. The story, the fundamentals of the lithium market still hold, although there has been not only a change in volatility in the prices, but also in the expectations. I mean, dropping from levels of $80,000 per metric ton to today below, let's say 15. Chinese market a little bit more depressed, has changed a lot in the expectations, especially in terms of the long-term prices. And talking about that, I think it's worth to mention that it's consistency is needed, not to be changing those long-term prices more often than it should be.
And then moving on to look at the spodumene market, obviously we saw over the past couple of years a lot more raw material supply from a lot more sources coming to the market. In particular, people rushing direct shipment ore, so ore that hadn't been beneficiated to the market. A lot of artisanal and tailing supply coming from Africa and to a lesser extent from Brazil, and also the Chinese lepidolite question. Some of that now, I think we're seeing leaving the market. But Jose, over to you. Any thoughts on what's happening in spodumene and where that's likely to stabilize?
Yeah, well, spodumene also has been quite dramatic in terms of the drop in prices. However, if you analyze the percentile changes compared to the lithium chemicals, it's still holding. And for the last couple of weeks, it still has been between 1,750. If you think so in terms of the tier 2 and tier 3 Australian producers, those are levels where they don't entirely face their cost of production, such as happened in 2019. So the situation is still not that dramatic, despite the updates and increase in cash costs from tier 2 and tier 3 producers. At the moment, everybody is observant with reductions in their forecast for this year, but there's probably no risk of I haven't seen at the moment companies mentioning plans to stop production.
Yeah, so we're not in the situation we were in 2019, early 2020, where you had assets going on to care and maintenance yet. It's possible that will happen. We have seen some slowdowns. We've obviously seen announcements such as from Liontown that, you know, their financing has to be renegotiated, and that's likely to delay projects coming online. The other thing that's worth mentioning is, even though when we spoke about chemical prices, we think they've stabilized and might increase, there's probably still room for spodumene prices to decline in reported prices over the coming weeks. And partly that's just because of the number of trades that can be trapped in spodumene is quite a lot less. So while fast markets, you can see here, Shanghai metal markets are reporting CIF Asia prices in the mid range of 950 or something. The lower range of those prices is down about 800, 850. And as I say, people are talking about 750 as a price level, which, you know, we may get down to. And we'll look a little bit later as to why that price level would struggle to stand in the long term or even the medium term. And one of the reasons for that is obviously because the demand profile is so strong. I want to move on to now. This is a slide that we presented in March 2023, when prices were on the way down, but they were ranging anywhere between $50,000 and $70,000 a ton for chemical prices. And what we did when we went through the lithium rainbow, as it were, you know, everything above $30,000 was so much higher than production cost that, you know, it's what we call demand destruction pricing. And that's something which, you know, I think has proven to be true. We didn't see really any changes to the supply output as prices came down through that rainbow until we got to the $30,000 price point. And that's when supply that had only really come into the market in 2022, because prices were so high, started feeling some pressure. So we started seeing people saying, well, let's get all our equipment and let's produce, you know, a 5.5%, 6% spodumene, rather than rushing out a very low grade direct shipping ore. The refining margins obviously collapsed from having to process this very low grade ore. And we started seeing less artisanal supply, both because of the economics of it, and also there were quite a few crackdowns in, you know, places like Zimbabwe and Namibia, looking at, you know, trying to curtail all of this artisanal supply leaving the country. Now we're down into the orange. And I think, again, you know, what we predicted would happen is happening. You're seeing a delay in CapEx, you're seeing a reduction in OpEx, you know, and the move is really going to making the profitable ton rather than the most number of tons that you can produce. And we've seen that in many commodities and mining markets over the years. So there's nothing really surprising there. The issue is that the increase in CapEx and OpEx hasn't gone away. And it will take a long time for that to come down. It will probably never come down to the levels it was before. And we're going to look at production costs in a couple of slides' time. Now, the big worry is that if prices do fall towards a, you know, $10,000 per ton level, you're going to be in a world of hurt. And it's going to cause the mother of all lithium price spikes and the mother of all lithium shortages, which will have a serious structural problem to the market, not just in the short term, but in the long term. We'll look at that on the next slide. What's really important to understand is, the lithium market has grown pretty steadily over the past decade. And, at the end of last year, 950,000 tons LCE or something like that, close to 1 million tons. But by the time we get to 2020, the end of 2027, the market on our forecasts and lots of other people's forecasts will be over 2 million tons. So the market needs to double in the space of about 4 years, given the demand profile that we're seeing. Now, if you can't pay your debt or service your debt or raise capital, it will be impossible to double production in that time frame. Prices cannot stay anywhere near that red sector, and I'd probably argue can't stay in the orange sector as well, and meet the growth profile that we have. And important to remember, lithium still doesn't have a very established network of above ground stocks. There are no warehouses like there are with copper or aluminium that can be drawn down around the world. Yes, we have some surplus stock, but it's measured in weeks rather than months as to what's available to the market. So I think the market would really struggle to meet the supply expectation if we don't see that. And then we'll look a little bit later as to the role that recycling will play as well. Any comments there, Jose?
Yeah, sure. You just mentioned about the repayment of capital, the companies that actually need to internalize these prices, that this is extremely helpful for a long-term price incentive. And we're going to dive deep into the operational costs of some of the technologies before going to the cost curve. But it's worth to mention that in terms of capital intensity, capex per unit, at the moment, I don't remember seeing salars or hard rock processes in the orange area. Most of them are in the yellow area. And now that we are analyzing more and more recycling in terms of operational costs, just for not even for the lithium share, but lithium bearing the entire processing flow sheet, it's most likely on the green side of things. And if you analyze secondary supply from a capex intensity, most likely it is above, now with certainty, it is above the $14,000 per metric ton level. So it is on the what is it, light blue side.
Yeah, I mean, our long-term price forecast, sort of incentive price forecast for good quality assets is, I think, sort of low to mid-20s at the moment on a carbonate basis. But certainly, for a lot of assets, they will need a lot more than that going forward. For those of you who are on our sodium ion webinar, I put this slide up there, but it's important for this one as well. And that's if, we do continue to have very weak lithium pricing, what's likely to happen to the market. And, we've got a sort of cautionary tale here. What happened to cobalt? 2018, you saw a huge price spike. And a lot of people worried not just about the price, obviously they don't want cobalt because of the reputational damage that it does. They had the option to get rid of it because of increased energy density with higher nickel, better thermal stability management systems. But there was a huge concern in the industry that it wouldn't be able to physically source the units, and that would therefore curtail the move to EVs. So you saw amounts of cobalt used in batteries quite steadily decline. Likewise with nickel, then a couple of years later, we saw nickel price spikes. They didn't last as long as with some of the other industries. But in reflection to that, we then saw a lot more nickel coming out of Indonesia, but we also saw huge growth in LFP output versus ternary cathode output in China. And obviously that impacts the carbonate versus hydroxide demand profile in lithium as well. Now, when we look at lithium, it's a bit harder to substitute away from, but it's not impossible. And as we discussed on the sodium ion webinar, we have seen about 140,000 gigawatt hours, 140 gigawatt hours of investments being made in China, a tenth of that outside of China. And, we will see how much of the market that share that can take. Our base case scenario is that it will take, 5 to 7% of the market. But if lithium prices spike and people get fed up with that and they can't source anywhere else, there is an alternative. We're also seeing an increase in the market share of energy storage systems, where it is more substitutable to go to sodium over lithium. It's a lot harder in transportation. This year's a critical year because we're only just seeing sodium ion really rolled out in mass market vehicles in China. We'll see how well they perform before having a final view as to the market share that will take. But there is a risk to lithium if the investment doesn't continue, and the investment won't continue unless prices recover from the level they're at the moment. So looking at where we are at the moment, we've been talking a bit about long-term prices. Let's look at where we view the market is in the short term. And you can see from the chart that we've got up there, we've split the supply chain into 5 main sectors. So we've got the raw material, we've got the chemical processing, so your carbonate and your hydroxide, cathode manufacture, battery production, end users. Now, it's really important to understand that the market inside of China, which is the majority of the market, operates very differently in terms of contract structures to the market outside of China. This is one of the reasons China's been able to grow so quickly, because there's slightly less planning, there's less long-term take or pay off takes. This is when you compare to the market ex-China. And what you've seen is that available pool of spodumene and other precursors effectively is at a healthy level. It's in surplus. If you want to go out and buy tonnages, you can buy tonnage. That's actually itself very positive for the independent European and North American refiners who are looking, really struggling the past couple of years to sign those long-term offtakes. But then when we look at China, what our analysts on the ground tell us is that the amount of material at refineries that's stockpiled is incredibly low. And as the demand profile is still quite good, so going all the way to the end, those orders will continue. Production of EVs, production of batteries will continue to increase. The market is negative because the cathode suppliers still have too much capacity, the cell suppliers still have too much capacity. They will do for years to come. But there is that tightness. And even though the market's in surplus, you still have a stocking and destocking cycle. So it's our view that if it hasn't started already, in the next couple of weeks, you will have to see a lot more purchasing from the Chinese industry. Obviously, that may be delayed a little bit by Chinese New Year, but those stock levels can't remain at that level. And it's also worth mentioning that 1 week level for those generally the non-integrated refineries, that's longer than it takes to order and ship material from Australia or Brazil. So again, that could lead to a tightening of the market. You're not going to see prices explode off the back of that, because there is still this surplus of material that can be bought, but we would expect inquiries to pick up, and we would expect prices, to stabilize and most likely increase as well, which may sort of stop the rot in some of the other markets. Now, outside of China, the supply chain is very different. And it tends to work on these sort of long-term take or pay off take contracts, where you guarantee that you will buy a certain amount of material. Now, those contracts are not generally for fixed tons. You'll have 70 to 80% that you have to take, and then you'll have an option as to whether you take the remaining 10, 20, 30%. And what we're hearing from the industry is that a lot of those optional volumes are being cancelled, and that stems from the Western automakers, generally the legacy automakers, slowing down their volumes of orders. And you would have heard that they're worried about margins, they're worried about Chinese competition in the form of exported vehicles, and that's created, even though in a growing market environment, is causing a little bit of a reduction in growth. So the battery producers, the Koreans, the Japanese, whether they're based in those countries or invested in Europe and North America, are seeing some reduced orders, and that's flowing through the supply chain as well. Again, not a sort of critical oversupply, but it is worth mentioning that that's happening in the industry. The price is almost all determined by what happens in China. the rest of the market is basically a price taker unless they've sort of fixed prices or done some collar pricing. So yeah, keeping an eye on what happens in China, keeping on that restocking. That's where I think in the short term, actually, we can be relatively bullish. And I say if we're not, it's going to lead to a world of hurt for lithium in the future, potentially an investment opportunity. But yeah, something to keep an eye on. Jose, any comments there?
Yeah, if there's anything positive worth to mention is that availability of material has created opportunities for the Western refiners of the Western companies trying to be a participant in developing projects in the North American, in the European lithium-ion battery supply chain, especially the refiners. There is material available. There is material that strategically wants to be put into those two lithium-ion battery supply chains, which is great. This has been a blessing, if there's anything positive to say. Nevertheless, you mentioned a very important point there, that those two markets are price takers, Chinese price takers. And if you're developing those two supply chains, and especially if you're thinking about protecting yourself in terms of price to create enough margins for the industry to be attractive, the Western industry to be attractive, it cannot be based on Chinese levels and especially dynamics.
Yeah, I mean, I can think of 5 or 10 refineries who, this time last year just couldn't source a tonnage. They were being asked to give equity away, pay ridiculous prices, and now the power has really flipped back to them. And that again, yeah, it's been a positive certainly for European industry and probably the whole industry outside of China. We're going to move on now to look a little bit at production costs and where price support is, both in the short and the medium term. Before we do that, I'm just going to I'm not going to go through all of this, but just to say, some of you will have seen these terms, C1, C2, C3 costs. It's something that was developed by a company called Trump many years ago. It was then bought over with McKinsey. But that sort of outlines what it is. So we're going to be talking about C1 costs on the next slide. It's basically your cash cost of production. So it doesn't include your depreciation, your amortization, interest payments, all that type of stuff that you need to actually build something. This is just what you need to operate your mine profitably or operate your lithium asset profitably. If you're getting a double production in 4 years, you're going to need a price which is quite a bit higher than the C3 level. So with that, Jose, I'll pass to you to take us through some of the broad cost analysis that we're giving away here on C1 basis.
Yeah, so this is, as you put it quite right, this is a C1. I don't want to say cost curve. This is even prior to that. It is a transversal cut of the different technologies, because instead of showing the massive cost curves, it's always worth to go back to basics. So we wanted to show you a couple of different technologies in terms of C1, starting with Salar, an Argentinian tier 1. With a cost that's very close to the $5,000 per metric ton, although the capital intensity is way high, especially after what happened with the price increase that consistently went up with the prices in 2021, 2022. B on a Salar with DLE costs are a little bit higher. And it's worth to mention that DLE is not substituting a conventional purification. It is a tool that enhances a higher purity of lithium chloride, basically, although with a lower capital cost on the final refining, purification, and evaporation. Then spodumene, and in spodumene, I would like to mention that there is some differences between an integrated and a standalone, in the sense of a tier 1 Chinese player. They typically have conversion costs that are, if not below the $3,000 per metric ton, a little bit on that range, although the variability is quite high. Then it gets a little bit into the red zone for a standalone producer facing the current prices, because On top of purchasing the material, this chart over there considers a price of $950 per metric ton SC6. Everybody knows, everybody that's in direct contact with the market knows that the majority of the spodumene is below 6%, especially if the market is booming. But this is more or less the long-term price incentive for spodumene concentrate. So on top of that, there is a transportation cost, a conversion cost that, in the case of European refiners, can even go up to 4,400 or even 5,000 if you're dealing with some of the new proprietary alternatives such as the Metso Autotech or similar. And finally, the lepidolite. Lepidolite you can find wherever you want. Both the costs are high, but especially the conversion costs are also on the high-end side. What is really worth to mention of this as a highlight in this slide is that we mentioned this at the beginning, is that at the moment, facing this type of prices, some of the companies might still operate. They might delay the decision of just putting the project on care and maintenance. But most important of all, they're definitely going to think it twice instead of doing the investment. So at prices below $10,000 per metric ton today, it's no-go in terms of high-cost spodumene prices, but especially in terms of the new technologies. Lepidolite, if they're not already shut down in China, they must be facing extremely hard conditions, and not even talk about secondary supply. We're more and more, in the next couple of slides, you're going to see that we've been more and more working into recycling of lithium-ion battery, and the prices over there, both in terms of capex or opex intensity, they are way above the roof.
Yeah, well, in the interest of time, let's move on to the recycling side, because you do have this new source of supply. Obviously, supply from recycling is a function of demand, however many years ago, on average about 10 years ago. And we're going to come back to a little bit of pricing and costs. So we've got some questions there.
Yeah.
Jose, you've spent a lot of time on recycling databases recently and making little maps that we can see here. Yeah, your thoughts?
You know that I love maps, so this is a surprise that we have for our beloved audience and subscribers. A Christmas present from last year. So yes, indeed, we spent a lot of time tabulating the more than 120 lithium-ion battery recycling projects globally. Some of the projects that are traditional smelters, others is just directly lithium-ion battery recyclers, other cathode producers, and even companies from other sectors. They're interested in this landscape. So all in all, we do have in-depth databases that account that take into consideration not only the ramp up, things that our competitors don't have, but also the type of chemistry, because this is extremely important not to double count batteries in general, especially if we're talking about lithium supply. There's a lot of crossover in the recycling industry, whereas one particular project can take nickel metal hydrate, nickel cadmium, lead acid, zinc alumina type of batteries, and they can also be a smelter. So it's very important to follow the companies that are focusing on lithium-ion batteries and have a hydrometallurgical approach as well. So all in all, this is a new venue at SC Insights, and we're quite happy to offer this not only for our subscribers, but for the new also potential subscribers of our product.
And yeah, just looking at some of the output numbers here from the recycling side. This is excluding China, but I think it's pretty clear that there will be enough recycling capacity to deal with everything. You're also going to have legislation that will mean these cells need to be recycled. Some questions on the margins that will be available, particularly if you're looking at lower cost LFP cells. But I think generally what we're seeing certainly for the next few years is NCM will dominate the supply of material coming back to market in Europe, and also production of existing material. Jose, do you want to go through this relatively quickly? So quite a few questions on the Q&A.
Yeah, sure. Just to sort of mention very briefly that what you've seen, the dotted line is only one side of the recycling potential material, which is scrap. Even considering scrap, one of the takeaways of this slide is quite an attractive market, even without accounting for China. It is a potential market that brings 250,000 metric tons LCE in 10 years time from now. That quantity, which grows at 23% compounded annual growth, it's expanding by 7. It's going to be even more attractive when we add to the equation those units coming from end of life spent lithium-ion batteries. On one hand, that's one of the takeaways from this slide. The other one is that processing capacity also grows. It multiplies by 6 on one hand, but as the market develops and becomes more attractive, and the incentive prices are aligned, something that we discussed on the rainbow slide, is also will incentivize to take the material, whether by economics, purely economic, or by mandate, European Union and material handling mandate as well. But at the moment, they're looking extremely promising, yeah?
Yeah, so we'll just summarize in the next few slides before opening up to the Q&A. So please do use that function. You know, I'd say the background to this is, yes, we're having supply and demand imbalances, but the demand story is still very strong. And it's really worth pointing out, because it seems to never make it to the press, that lower prices increases demand. Now, it may not change a huge amount to the EV production outlook, and I don't think many forecasts have changed that much. Ours haven't. But on the ESS side, you know, this is a sector that was constrained by cell supply, you know, just a year ago. And, you know, we've seen the huge increase in solar installations in Europe because of the lack of Russian gas supply. We're seeing huge increases in China, huge increases in the US and elsewhere. And that market really ballooning because you have these inexpensive cells, typically LFP cells, now widely available. And, you know, if anything, we see a surplus of up to 300 gigawatt hours of capacity in that side of things. So the demand story is still there. It's still strong. The political mandate's still there. Going through these points finally on the trends to watch, I'll start with number 6 because I just referred to it. I think particularly over 2024, you know, you've got quite a few key elections coming up, particularly in the US, obviously in places like Indonesia, the UK as well. You're likely to see a bit more politicization of the energy transition. I don't think you're going to see walkbacks on, you know, the move to EVs. You may see people delaying the transition, delaying the phase out of ICE if it's seen to favour China too much. And obviously, you're going to see protectionist barriers continue to increase. Again, particularly here in the EU, you have that investigation ongoing. Critical year for sodium ion to see just how well it can deploy in the transportation market. We'll be watching that very closely here. On the raw material side, you know, not just in lithium, but in nickel, in cobalt, in manganese, graphite, I think the price declines have pretty much run their course. They're obviously, you know, unique things to each market, but you're not going to see a big decrease in raw materials from now. And if you do, you're just not going to see the investment that's needed in the supply chain. And we'll be back to a situation as we were in 2020 in the lithium market just before a huge price boom, which isn't good for the market in the long term. Oversupply in certain parts of the supply chain, particularly cathode and battery cells on a global basis. It's going to last for a very long time, given how much capacity is being rolled out in China. Regionally, you still have deficits in Europe and North America for most stages of the supply chain, particularly on the anode side of the market. And yeah, I think, you know, probably the negative sentiment that you see in the press is slightly overblown, and partly because, you know, there's a lot of people who invest in equities who've been quite burnt by moves in those markets recently. So moving on to the Q&A. First question, one for you, Jose. It's just if you could comment a little bit on the recent SQM and Codelco agreement.
Oh, sure. Well, very briefly on that agreement that does not only impact Salar de Atacama, but also Salar de Maricunga, the second best asset in Chile. It is quite positive for both companies. Obviously, it gives continuity on not only the current production of SQM in order to go beyond the 210,000 metric tons capacity, but also it backs up the R&D projects that SQM is developing at the moment. And obviously Albemarle, they're doing something quite similar on direct lithium extraction. Lithium on one hand, the other one is increase in yields and recovery from all stockpiles as well, which is going to bring most likely in the range of 50k additional each. So it is positive in terms of the overall picture of the Chilean output. It also gives Codelco a backup in terms of the new mining tenements that they're enjoying in Maricunga in order to consolidate that salar. Although it is a bit tricky for this second company, because you never know whether it's going to be they're going to open up for a new entrant in order to help them developing the project, or they're going to just simply get rid of the project and sell it entirely. The only drawback that I can see is that in comparing it to the Argentine landscape, it unfortunately concentrates a little bit more the Chilean market panorama. It doesn't solve the issue of developing the beautiful and highly attractive assets that Chile has, extremely good assets in terms of lithium concentration. But I'm extremely happy by SQM, by largely the best lithium company around.
Then next question, given the current and medium-term price environment, do you think any of the European lithium mines, e.g. kind of Ekans involved with that financing to production? These are typically in Europe, you've quite small scale operations and deposits, excluding the Adda deposit in Serbia, quite often towards the top of the cost curve. Jose, any view there? I know you're in touch with most of the European industry.
Yeah, I'm in touch with the majority of the European players, although we source globally. So I'm a little bit biased on that behalf. In fact, this is my personal take. Is more convenient to secure the material from recyclers than local European players. There's always this environmental constraint, delays and revisions of the projects because the economics are quite challenging. That said, there's quite an attractive bunch, not more than 5 projects in Europe.
We've got a question on care and maintenance projects. What are the immediate effects on the spot market? For example, Core have they've sat on a stockpile of about 6 months of material to process. We haven't seen a huge number of care and maintenance announcements. Core, I think, is a sort of special example who went to DSO because they saw an opportunity and took it. Famously walked away from that Tesla offtake. Yeah, I mean, in terms of the impact of care and maintenance projects, I don't think we're seeing at the moment. I don't think prices are low enough for the majority of operations to consider closing. They are going slow. There may be some stockpiling as prices are declining. You're seeing some tonnages being moved around as to when they're shipped at Greenbushes. I think that's more a pricing issue. But yeah, if prices continue to decline, we will start seeing care and maintenance. But by that point, given the demand profile, it's just really you can't go into low pricing for that role. It just won't happen.
And if you think so, core always was thought as a project to get in and get out. I mean, initially.
Yeah.
Yeah.
And yeah, just speaking about the demand side, I actually just got an email saying my new electric car's been delayed for yet another month. So you know there is still a backlog here in Europe on electric vehicles. Yeah. So yeah, very upset with Audi at the moment. Not the supermarket, the car company. Right, next question. Is there much transparency on lower cost lepidolite production in China, e.g. from CATL's mine and perhaps some others? Is it possible that some of this production is being subsidized and so distorting the spot market? One thing I'd mention actually, if you think, just a year ago, or less than a year ago, CATL were offering a 20% discount to their loyal customers if they would fix their price at $29,000 per ton. I wonder how many of them took that, and I wonder how many of them are still paying $29,000 per ton, because I suspect not many of them are. So yeah, there are distortions in this market. Despite the prices that we see, there are a lot of fixed prices, there are a lot of collar prices, and it really comes down to individual companies as to the prices they get. What's reported from the PRAs doesn't always tally with a lot of the trade data that we see and a lot of the specialist grades that we see. So there's a huge amount going on there. May say any impact, any view on the lower cost Chinese lepidolite?
Well, yeah, there are a couple of projects that are worth mentioning. The CATL, Ganfeng as well. But then again, you need to dive deep into not only the information that's available, but also the technology. Yeah? There's a mix between that and the subsidies that actually build the whole lepidolite scenario, but then again, it's a high cost industry in average, whether it is subsidized or not. And besides, it is quite a contaminant industry. You think about the volumes. If spodumene, it is 1:8 in terms of ratio between tonnage of lithium carbonate equivalent to spodumene. The other one is 1:22. So the environmental mess that they're creating is their own problem now.
Yeah. Sure. And then on slide 7 on lithium inventories, how long does it take lithium units to move through the entire value chain? So, when obviously it varies with each individual supply chain, but if you consider that you've got, let's look at the spodumene as the biggest source of supply, you've got to ship that up to China, or the majority of it to be refined. There'll be a little bit of shipping and stockpiling within China, then to the cathode, then to the battery, then to the end user. Typically, that whole process takes 9 to 12 months. Or with Audi, I'm going to say that they sit at a port for 3 months at the end, which is where I am. But yeah, we look at that as taking about 12 months. So when we look at the sale of electric vehicles, that doesn't correspond to demand today. The sale of electric vehicles is basically about 12 months offset, because you've got all of these stages in the supply chain of that material and vehicle, have to go all around the world. Possible that comes down to 9 months at some point. It's certainly something that we have flexible in our models. Prices in Korea and Japan have declined but remain much higher than China. Average prices in 2023 were higher than 2022. What are your thoughts for the ex-China price in 2024? Jose, do you want to start with that one, or shall I?
Yeah, no. Then let me mention a couple of comments just before. Well, that is correct, and that's solely due to the rolling over effect. If you track the contracts, they are either, and especially in Korea and Japan, some of the major cathode cell producers renegotiated the contracts with the largest 6 producers. Must have been 2020, early 22 or late 2021. So you can see there's an explanation over there. Majority of the volume traded by them and used by them. The other reason is because of the rolling over effect. The contracts tend to update every quarter, or some of the contracts twice per year. So you're going to face a delay over there in what's happening between the spot market or the PRA input of information and actually the performance of the contract. And finally, the effect of the contract itself, the design of the contracts, whether they're using price caps, price floors, fixed prices, etc. And obviously, Northeast Asia is always more conservative on the contracts than the Chinese market.
Yeah, and it's worth mentioning, you know, as we got on this slide, you know, China's a mixture of spot and contract. Outside of China, it's pretty much contract. You're not taking a spot price, you know, at a minimum, you're taking a monthly average. Quite often, you're taking a quarterly average price. Quite often, there are delays as to when that price comes through because of the way that the cost pass-through mechanisms work. And typically, that means you have lower highs and higher lows than the spot market. Then, quick one: are there no recycling projects in France?
Yes, let me take that one. And we probably forgot that slide, but there are 7 at least that we have put into our database. And actually, there is an analyst just texting us that. And it's not included in rest of Europe, basically because we treated Germany because of the density of projects. Then we have one for France because, again, the density of projects. And then we have another slide for the rest of Europe. But Europe is taking the lead in terms of projects. I can't remember how many, but at least 50 all in all.
Then what are the external factors other than the lithium industry responsible for the downfall of lithium products? Not sure if that's meant to say prices at the end. I mean, I think there are a number of things, and as we've referred to a couple of times, sentiment in the market has really changed. Certainly, that's impacted equity valuations quite a bit. Sodium ion, you know, doesn't really have a material impact yet on lithium demand and lithium product demand. The battery side's going up. You know, we're seeing an increase in prices, so an increase in demand for material. So yeah, I mean, I say a lot of it really is sentiment driven, and the fact that you do have overcapacity and you've got these stocking cycles, which are now really impactful on the market. Certainly, that's what we spend a lot of time tracking. Other than that, any external factors, Jose?
Not that I can think of at the moment.
Now that the price of hydroxide is lower than carbonate, how long do you think it will last? And this is referring to I think in the Chinese market, certainly the prices of carbonate are quite a bit lower than hydroxide. If you can squint hard enough on this chart. Part of this again comes down to the contract versus spot pricing. So carbonate's more likely to be spot priced and more likely it's a bigger market in China. You also have this big move to LFP production in China that's seen the share of carbonate increase over hydroxide. Hydroxide's more likely to go into high-end batteries, which have a contract structure price, which means that those prices lag. And we've seen historically, you know, a leading indicator of the hydroxide price is the carbonate price.
Yeah.
The other thing that you get is because you've got enough refining capacity in China, and we've seen this a couple of times now, is when you get an arbitrage between the two, people will take hydroxide and convert it to carbonate if they can do that profitably. So it won't last for long. And in some respects, it's a bit of an aberration in the way that the prices are reported.
Although it's worth mentioning that I wouldn't pay too much attention on that or spend too much time because China is a market but lean towards the consumption of lithium carbonate. I would trust, obviously, the numbers on carbonate there for LFP, but the majority of the conversion of spodumene to lithium hydroxide made by Tianqi, Ganfeng, Chemfis, etc., ends up all being consumed by the majors, some manufacturers and cathode producers in Korea and Japan.
Then a common question in North America from asset developers, e.g. DLE brines, etc., is how the offtake market in North America will develop alongside raw material production. Do you expect chemical refiners to build up in North America with an interest in lithium chloride offtake, or do you expect that developers will be expected to produce their own lithium carbonate product? So I think this question is looking at, if you've got the output from a DLE production process, they may take that to a chloride, or they may take that to a technical grade carbonate. The demand may be for hydroxide. Are they going to do it themselves? Or are they is it going to go to a third party? Will that be told? Where's the price risk, Jose?
Well, yeah, let me see if I understood the question correctly. But if this gentleman is thinking of exports of lithium chloride, I would say it's much easier to do a rough, cheap carbonation inland, remotely, let's say, well, in Argentina mainly, or the case of Bolivia, because in Chile you cannot export lithium chloride. That's a no. That's a dead alley. But in Argentina, yes, I would do a cost beneficial carbonation for a couple of extra hundreds of dollars before shipping, because of the volumes. Then, because it's easier to ship it, and then lithium carbonate takes the shipment from one hemisphere to the other much better than any other product. In the case of lithium chloride produced in North America and refined in North America, it is a bit of a different situation, but the projects are integrated, most of them.
Yeah, and it's worth mentioning that there is a refining sector developing that will be taking off-spec carbonate, will be taking various recycling streams and other products. So you're seeing a burgeoning of the types of input products that you have. It's not just chloride, it's not just spodumene for refineries going forward. Sticking with DLE, what are our latest views surrounding scalable direct lithium extraction technologies? Are we still some time away? When do we think the big impact of DLE will be felt, Jose?
Yeah, well, it's worth mentioning that on DLE, the only successful group of projects at the moment is Adsorption, and specifically Leyland, who I can't remember what's the current name of that merger, or Chemio? No, you probably know that better than I do. But Leyland, formerly FMC, although that project, which is that technology, in fact, which is high capex, low opex, is bounded by Arcadium. Thanks so much, Joe. Joe is texting me on the back. It's constrained by water use, so be quite careful on what you read about scalability of lithium adsorption. Nevertheless, the majority of the new projects or R&D developments in South America, I'm just thinking out loud here, the Salar Futuro of SQM in Atacama, Albemarle, then who else? Tsingshan and Eramet, they're all adsorption from one way or the other. So they're kind of scalable, but in a modular sense. Some of those projects rely on modules of 10,000 metric tons, 5,000 metric tons LCE. So you have to be kind of careful with scalability in that sense. With regards to the other technologies, ionic exchange, there's a lot of offers of services in that space, but none of them has proven to be economically attractive nor scalable at the moment. So I'll be even more cautious on that area. And finally, membranes, which is in diapers at the moment. So
we've got about 5 minutes. There's about 10 more questions. We might not get through to all of them. The next one was also about DLE. Is it a game changer? I think the interesting one, the correct part of this question here is, can DLE give more flexibility in the brine sector in order to be responsive to variable demand? Jose, do we think that we've got lots of DLE projects up and running? Are they going to be coming in and out of production because they can do that a bit easier than traditional sellers?
Yeah. So that's a great question. It is spot on. Let me start by saying that DLE is not replacing, it's not competing against conventional evaporation processes. It's actually a tool that enhances a better yield. It improves, actually, being very concrete. It actually improves the concentration of lithium chloride. That's all it does. So it helps to enhance a better, at the moment, a state-of-the-art low levels of recovery between 45 and 55% yield on conventional evaporation ponds. Being that said, it does help projects that have constraints on space. It's quite suitable for Argentinian projects that don't have enough space to deploy those large evaporation ponds. So, but I truly believe it is here to stay and is a useful tool. It's under no circumstances substituting capacity that needs to get that it's coming to the pipeline on the conventional side.
A question here: do long-term supply estimates allow for resources that haven't yet been discovered? I think that one, yes, they do. We've got almost 400 projects in our database on the lithium extraction side, and to be honest, if all of them got built, you'd have about 5.5, almost 5.5 million LCE production. So, not all of those will happen, and there will be new ones that come out and come to market. But we have actually discovered all the lithium we need already. It's a big question of financing and timing, but there are enough projects already. It's a question of getting them built. And there will obviously be ones that haven't been discovered yet who come to market and obviously fall amongst the wayside. Next question: will the value addition of miners, refiners in chemical production be 50-50? How will the margins get distributed during the upcycle process? Will any Chinese refiners have a competitive advantage in refining spodumene, or will it become an established process flow sheet? So I guess the question there, and I'll turn it to you, Jose, is who's going to make the money?
Well, that unfortunately is inside information that I cannot share for obvious reasons. But good luck with that. There is public information that you can check, that our audience can check on that topic.
I mean, what I'd say with all of these things is, if you're down here on the left side of the cost curve, you're always going to do pretty well. And if you're over to the other side, you're not going to do so well. Integrated operations have, a chance to take 2 bites at the cherry, as it were. They can make money on the hard rock, they can make money on the chemical. That's not the case if you're only doing one. We hear about OEMs such as Honda, VW, and others looking to invest billions into battery facilities. Why are these investments so slow to materialize when the need for the materials is only increasing? In your opinion, Canada, specifically Ontario, being sought? So, in your opinion, is Canada, specifically Ontario, being sought after a location for these battery plants? So there's a lot going on behind the scenes. I think particularly in North America, you will see more announcements in the supply chain. You've probably got enough battery plants that have been announced. There'll be 1 or 2 more. Most of those are still looking for financing. It takes a long time to raise those billions and billions of dollars. but it seems to be happening. When it comes to Ontario, Ontario basically has a lot of the car production in Canada, whereas Quebec has a lot of the resources. So what you've seen in Quebec with the cheap hydropower and the area around Bécancour is you've got people saying, look, we get the raw materials, we'll do the chemical processing, we'll make cathodes, etc. Whereas in Ontario, it's a bit more, we've got the car production. A lot of the car producers have various tax credits from previous debts, just a good quirk of the Canadian taxation system, and they're getting some of the battery plants investments. A lot of incentives from both Quebec and Ontario and federal Canadian government there. Yeah, Canada's got a lot to win from this, and the various government departments that we're in touch with there are very proactive in doing that. So I expect you will see more positive announcements and job creation in Canada. What are your forecasts for lithium demand in ESS? I don't have that number to me, but I can get back to you on that one. How do you see lithium carbonate technical grade availability? What about pricing? Reference to carbonate with a battery reference for technical grade reference to battery grade with a discount, or will it have its own pricing arrangements? Jose, quick comment on technical grade, and then we'll do one more question over that because we're already over time.
Yeah, well, if you're looking for availability of carbonate technical grade, Argentina is a place to be. I would say starting from 2026, we're going to start seeing a lot of new tier 2 companies pumping more material into the market, which will need refining. On the pricing itself, yes, that's one option. You can peg it to our lithium carbonate battery grade, although you still have a lot of historic information on pricing of carbonate technical grade, the origin, the destination, to build a good model on that.
And then finally, one on recycling. What are your assumptions in the lithium supply from end of life recycling, things like yield, recovery, product quality, given the current technologies and the probable location of actual recycling activity?
Well, on the supply side of end-of-life material, there is a big assumption on the scrap linked to the lithium-ion battery cell production, which at the moment ranges between 10 and 15%. As those companies mature in time and navigate through the learning curve, that those percentages are going to stabilize close to 10% or a bit lower, but that's when the end of life new stream starts to kick in. And on the refining side of things, I think I mentioned a bit on the assumptions. Then again, pay special attention if you are checking those databases, pay special attention on two things. First of all, the ramp up of the recycling projects, so they don't reach capacity as such. Consider a capacity utilization and a reasonable ramp up or start date after commissioning. And the other one is be careful on what type of chemistries they're recycling. It's not the same to being adding capacity on lead acid with nickel metal hydride and some other.
If we had to put a percentage assumption on, say, hydromet technologies, what would the recovery percentage be? Low 90s, mid 90s?
It is close to 95 or above. It usually what we have seen on the recycling side is that all projects tend to be, the majority, especially the Japanese, all pyrometallurgical, and at the moment the new projects, they're all hydrometallurgical process, quite focused on lithium-ion battery recycling exclusively.
With that, apologies for not getting through all of the questions. We'll try and reply to those offline. Thank you all for joining, and as I say, in the next couple of days you will be sent a link to the slides and the recording.